Welcome back to our part 2 of our discussion of Chapter 9 and tax credits. So the next one we will need to discuss is the foreign tax credit. Now the basic idea is that you get a credit if you live and work overseas, outside the United States. As a U.S. citizen, no matter where you live, you still have a tax liability inside the United States. But if you pay taxes in that foreign country, then you can take a credit, and that will reduce your tax liability in the United States. So it is equal to the amount you paid in foreign taxes, but not greater than what your tax liability on that same income earned over in a foreign country would be taxed in the United States. So you can't get a credit for more than what you would have paid as a U.S. citizen on that same income, absent being in the foreign country. So we calculate the foreign source taxable income and divide it by all of our taxable income, and then we take that percentage. So what percentage of our income was earned in a foreign country? We multiply that by our tax liability, okay, to get the amount of income tax that's attributable to that foreign income. All right, now note you can deduct this as a deduction, but it's rarely advantageous to itemize this foreign taxes rather than just take the credit. But it could happen. All right, so it's available for taxpayers. You have to have earned their income overseas and paid taxes to wherever that income was earned. So an example of how we take that percentage, you take the $63,000 we have as worldwide taxable income, $8,000 taxable income in New Zealand, where she paid $2,500 in income taxes to New Zealand. Here her tax liability in the United States, given all of her income, is $17,640. She calculates what percentage of her total income was earned in New Zealand. 8,000 divided by 63,000. Okay, and then we multiply that by how much her tax liability is in the United States. So out of the 17,640, 2,240 of her tax liability is due to the income she earned in New Zealand. All right, so she can take a credit of the lesser of the $2,500 she paid in New Zealand on that income, or what she would have paid if she'd earned it in the United States. And so she takes the smaller of that, which was $2,240 in this case. All right, far more common. Most of the returns that you look at, okay, or a very large number, are going to involve the child tax credit. Children under the age of 17, okay, so a qualifying child under the age of 17, the year they turn 17, too bad, okay, they become an other credit, all right, and the other credit, other dependent, is a non-refundable credit, but the child tax credit for under age 17 is at least partially refundable. Child must be a U.S. resident or citizen, has to be younger and unmarried. It's $2,000 per child. You can see that is a significant amount of tax liability that can be reduced. Okay, if you have $4,000 of tax liability because of your income, and you have 2 children that qualify for this, and you're not phased out, that's going to wipe out your tax liability. Okay, refundable up to $1,400. The phase out is very high, as you'll see in the next slide. Phase out starts at $400,000 for married filing jointly, and $200,000 for all other taxpayers. Okay, and unlike the phase outs we've talked about so far, where they kind of phase out gradually between 2 levels of income, this is all about the dollar amounts. The credit is reduced by $50 for each $1,000 or fraction thereof over the threshold. So a single taxpayer has AGI of 217 and one qualifying child. Her tax credit will be at $1150. So 2,000 minus 850. All right. So 850 is $50 for each $1,000 over 200,000. So over by 17,000. So 17 times 50 is 850. That's how much is reduced. So instead of being 2,000, you subtract out the 850, you get 1150. All right, they can be refundable up to $1,400. Never can get more of a refund than you can't get the whole 2,000 as refundable. You file 8812 to do so. All right, so we've talked about the phase out, we've talked about the qualifications there. All right, retirement savings contribution credits. This is an interesting credit in that when you make contributions to your retirement plan at your employer, they will take out the money out of your check, they will match it or something, and that income will not show up on your W-2. Meaning it will be excluded from your taxable income because you can take the number right off the W-2 and put it on the 1040. They subtract out, before they put the W-2 together, the amounts you paid in for retirement. And based on that, how much you put in, you could also receive this retirement savings contribution credit. So in a way, you've gotten two benefits with the same amount of money you saved. So this is a very useful credit, but as you'll see, it phases out very quickly, meaning it's not very helpful for anybody making very much money, even the median income in the United States. So this is how you qualify. You have to make contributions to one of those types of plans, and you apply the percentage. Remember, your credit reduces your tax liability by a percentage of the amount you put into the savings account. You can never consider more than $2,000. So if you put in $6,000 into your IRA, the most that can be considered for this credit is $2,000. And your percentage, how much you can use, is dependent on your modified adjusted gross income and filing status in the following way. Here is the chart, if you will, reproduced from your textbook. If you're joint, your income's between those two levels, okay, then you get 50% of the amount you put into savings up to $2,000. If it's between those two, you get 20%. So look how much difference. Your income is $38,990. You get a 50% of the amount you put into savings and credit. If it's $39,020, your credit goes down to only 20% of what you put in. All right, your income goes up again. It's only 10%, and then if you're over 65, 0. Over 48, 750, 32, 500, 0 for single. So you only get a 50% credit if you're up to 19,500. Okay, that's how this plays out. So example, AGI 52,000, married filing jointly, so we haven't completely got off of the income chart. $1,500 during the year, that's under the 2,000, so we're good. So we take 1,500 times, looking at the table, between 42 and 65, 10%. Roger's head of household, AGI 26. He made 2,200. Can only consider 2,000. All right, but because his income, head of household, all right, is under 29,250, then he gets to 50% of the 2,000 after it's the maximum $2,000. Adoption credit. Notice that credits are generally given by tax law, by Congress, as a way to reward certain behaviors that Congress think are important or that they're trying to encourage. So the better the credit, or the higher the credit, you might say, the more encouragement they're providing to taxpayers to engage in certain behaviors. So like saving money, like the last credit. This one is about adoption. 100% of qualified adoption expenses paid. Okay? Generally have to file jointly, and it's limited to $14,300 per child adopted. Typically in the year the adoption is finalized, you take that credit. All right? This is non-refundable, so it will only go to do you good if you have a tax liability. Starts to phase out at $214,520, completely phased out $254. That's a $40,000 phase out range. Different than we've encountered previously. We've had $20,000, we have $10,000, but this one is $40,000. And then this is the example of using it from the top of the range, subtract the modified adjusted gross income, and then divide it by the $40,000 to get what's the remaining adoption credit. Okay? If your expenses go over the $14,300, then you're limited to $14,300. And then you would then apply this phase out after you've done that. If the adoption expenses were below $14,300, we would use the adoption expenses. All right, the earned income credit. This gets a lot of attention, applies to a lot of different taxpayers. It is refundable. That makes it one of the most advantageous tax credits. You have to know quite a bit of information about the taxpayer to be able to figure out what it is. Yeah, depends on filing status, number of qualifying children. It's even available for those who have no children. But none, 1, 2, 3, and then 3 or more. Or 3 or more all lumped together. And you have to have earned income. So if there's no earned income, then there is no earned income credit. And here's the definition of earned income: wages, salaries, tips, earnings from self-employment. Okay. Notice that unemployment is not on that list, and some other forms of income. All right. So if you don't have a child, the eligibility is much more limited than if you do as far as the ranges of income that it applies to. It goes away at a certain level of income when it gets too high, okay? And it can be disallowed if you have investment income more than $3,650 in 2020. So you have to pay attention to make sure that there's not too much of that type of income, interest, dividends, that sort of thing. So the maximum, and you see that these are quite generous, $35.84 for a child, having one child, $59.20 for 2 children, $60 for 3 or more, and if you know, it's considerably reduced, but it's still available, $538. That's the maximum. So what happens is, as your income increases, your earned income credit increases until you reach a certain threshold, and then it's basically the same for plateaus over a certain period of time, and then as your income continues to increase, the amount of the credit drops or is reduced until it gets to a certain level of income, 0, depending again on your filing status, okay, and the number of children. But probably the easiest way to find the earned income credit is to use the earned income credit tax tables. Now, there's a formula in your textbook, but I think it's easier, less mistakes, if you just use the EIC tables, which are provided in the textbook. You do look up on those tables two things. You look up AGI and you look up earned income. Same table, and you pick whichever is the lowest amount. And what I mean by looking it up, you're looking based on income, and you're looking at based on number of children, or filing status across the top. You find the amount of the credit using AGI and using earned income. And take the lower of the two as your credit. That's the way to do it. There's an example in the learning module. Premium tax credit become less common, but if your income is between 100 and 400,000 of the federal poverty level, then you may receive a credit that help you pay for health insurance by giving you money. Okay, this is potentially refundable, and it's based on basically the couple of things: the premium that you pay through the marketplace if you buy insurance through a state-sponsored marketplace to get health insurance. Also, the premium for the applicable second lowest silver plan minus what you paid. Okay, that is calculated, and then basically, if the credit's available, some people receive it all along, meaning they go to a health insurance provider. They tell them what their income will probably be for next year. They quote them a price on the health insurance. Okay, they look at it compared to what you have to pay on the premium versus how much your income is supposed to be. Figure out what your credit should be to offset the cost of insurance, and they only charge you the difference. So if your credit was $400 and the cost of insurance was $500, okay, you would only be paying monthly $100. At the end, on your tax return, you're going to compare what your income actually ends up being compared to what it was estimated, and see what your credit should have been versus how much they already gave you all along. So if your credit should have been 120 and you got your credit was 400 to go against payment of the premium of 500, and it should have been 450 each month, then you'll take that $50 you were under credited times 12, that would be $600, and you would get that as part of your refund. If instead you were given $400 credit each month and your credit should have been $350, you'll end up paying. So this could come back to be an extra tax that because your income was higher and therefore the amount of credit you're entitled to is lower than what you were actually estimated at the beginning of the year. Well, that's the end of Chapter 9, Information.